Hello and welcome back to the course. In this video, I'm going to take a look at a fatal mistake, dollar cost averaging. There is an old expression on Wall Street that dollar cost averaging is the best way to go. And unfortunately, Wall Street stockbrokers have made a living off of this, convincing traders to do dollar cost averaging. Dollar cost averaging simply means to add to a losing position, and the idea is that eventually the market turns around in your favor and you have several positions at lower levels. You've bought that stock or that currency, at lower levels, so you've made your median cost, your average cost, much lower. Now, in theory, that works quite well with markets if you have a long enough time frame. And, most Wall Street brokerage firms are selling the idea of retirement accounts. So the idea is that if you have 40 years, if the market falls to the next two, then you are only picking it up on the cheap and you will eventually have more profit because you're buying that financial instrument at a cheaper level. However, this is absolutely toxic when it comes to the trader because the longer term investor, if you're 23 years old and the market falls a couple years in a row and you're buying things cheaper, then, in general, you're going to do quite well because you're not going to be able to touch that money, depending on the country you live in, for 40, 50 years later. So, yes, the market should turn around eventually. But for the trader, it's a completely toxic way to go. I have the weekly S&P 500 chart in front of you, and this is a CFD market, which mimics the futures contract. And here, in June or July of 2007, we have the market hovering right around 1560, maybe 1600. And, we fell a bit. And you could say that there were probably stockbrokers telling people to dollar cost average when we pulled back. There were little murmurs of trouble in the market, but they said, look, it's on sale, and they bought. And you can see we fell again, and then they bounced, and, somebody probably said, hey, we're still cheaper, let's buy there. And you can see that we continue to go lower. Well, the problem with this type of trading, with like a futures account, CFD, Forex, whatever, is that you have leverage at play. So not only are you adding to your position and hoping to turn things around, but now your losses are compounding. And this move here, now granted, this is an extreme move, but would have completely wiped out any trader that had anything to do with leverage. And we saw that more than once. But, furthermore, what really can cause a problem is while you're messing around with this, there might be another opportunity out there that you have all of this capital tied up in when you could be making money somewhere else, something going with the trend. As a trader, you need to recognize when you are out of a trade and when you are wrong. So if we pulled back here, and the same scenario, and you had a stop loss wherever it was, maybe it was underneath this candle. Once you break through that stop loss, it's time to get out. There's no need to throw good money after bad, and that's exactly what you were doing when you're dollar cost averaging. This is not investing for the long term. This is trading. So you are trying to make a profit now. You're not trying to make a career out of a trade because, quite frankly, if you were trying to do that and you got in here, say at 1385, look at how long it took to get your money back. And that's assuming you could have held through that volatility and that massive sell-off for 4 years. So the markets, and you could say the same thing about somebody going short at this point. We are overextended by any measure, but you can't fight this, and you certainly can't add to it. So keep that in mind. Set your stop loss. Obey your stop loss. When you're proven wrong, get out of the market. Protect your trading capital.